How does the futures market influence implied volatility? Have you ever wondered how the futures market affects implied volatility? Understanding this connection can be a game changer for options traders. Implied volatility, or Roman 4, is a key factor in options pricing. It reflects the market's expectations about how much the price of an underlying asset will move in the future, expressed as an annual percentage. The futures market plays a significant role in shaping implied volatility. Futures prices act as a reference point for the expected future price of the underlying asset. When futures prices fluctuate, they directly impact the implied volatility seen in options prices. One way this happens is through price expectations and volatility transmission. Futures prices reflected the market's consensus on future supply and demand. When these prices become more volatile, it signals rising uncertainty. This uncertainty translates to higher implied volatility in options prices, as traders anticipate larger price swings in the underlying asset. Another aspect to consider is the volatility skew. This refers to the difference in implied volatility between call options and put options at various strike prices. When futures prices change, it can shift this skew. For instance, if futures prices rally sharply, call options may see an increase in implied volatility compared to puts. This shift can affect option premiums and trading strategies. Supply and demand dynamics in the futures market also influence implied volatility. The volume and open interest in futures contracts can indicate changes in market sentiment. Increased trading activity in futures often leads to higher implied volatility in options, as traders adjust their positions based on new information. Market events can also impact futures prices, which in turn affects implied volatility. Events like earnings announcements, economic reports, or geopolitical developments can cause sharp movements in futures prices. These moves raise uncertainty about future price levels, leading to increased implied volatility in options as traders price in the risk of significant price changes. For options traders, monitoring futures market volatility is essential. A spike in futures volatility, especially before major events, typically leads to higher implied volatility in options. This increase can raise option premiums, providing opportunities for traders to adjust their strategies. For example, traders might buy options to benefit from expected volatility increases or sell options when implied volatility is high. In summary, the futures market serves as a barometer for expected price movements and uncertainty in the underlying asset. Changes in futures prices and their volatility directly influence implied volatility in options markets. By understanding this relationship, traders can make informed decisions in stock and options trading.